Hello and welcome to the Weekly Outlook at XM.com. Over in the U.S., all eyes will be on the next round of U.S. employment data, while debt ceiling negotiations will also be closely watched. And over in Europe, we'll get inflation numbers, which will impact the euro's path. I'm Maria Bashordeves, and joining me is senior investment analyst Marios Hadjikyriacos. So Marios, over the past month, the U.S. dollar has been doing well. What are markets currently pricing in for the Fed's meeting in June? And how might the upcoming non-farm payrolls data due out on Friday impact the Fed's decision and the dollar?
Certainly. Hello, Maria. So the dollar started the year on a pretty weak note, but it staged a massive recovery this last month. And that came on the back of some widening interest rate differentials and safe haven flows. Now, let me unpack that. We got some encouraging economic data lately from the US. Specifically, we got some business surveys that highlighted the resilience of the American economy. And in the aftermath of those surveys, we've seen the markets play around with the idea that the Fed is going to raise interest rates one final time this summer. So market pricing, as we speak, the markets are pricing in a 40% probability for the Fed to raise interest rates in June, and that increases to 85% when we look at the July meeting. And very importantly, the rate cuts that were priced in later on in the year have been mostly priced out because concerns that the recession is imminent, those have faded away. So the market is pricing in a final rate increase, but Fed officials seem split on whether they want to tighten any further. Some policymakers want to raise interest rates again, others want to pause, but I think that the majority is still on the fence. They prefer to examine another round of economic data before they make any decision. So there's going to be even more attention than usual on the upcoming employment report on Friday. Now, the forecasts point to another solid jobs report. Non-farm payrolls are expected at 180,000. The unemployment rate is expected to increase, but just a little bit. And wage growth is expected to accelerate. Now, what I want to point out in terms of any surprises in this data, non-farm payrolls have exceeded estimates 12 times in the last 13 months. So it seems that economists are consistently underestimating the strength of the US labor market. Now, funnily enough, we could see this phenomenon repeat this time because if we look at business surveys, the latest PMIs from S&P Global pointed to the fastest increase in employment growth for 10 months. And the same surveys also pointed to intensifying wage pressures among businesses. So it looks like it's going to be another solid report. And if that's the case, that could solidify expectations that the Fed is going to raise interest rates one last time. And equally, it could lead investors to unwind some more bets for rate cuts later in the year, both of which I think would be beneficial for the dollar.
Moving over to Europe now, the euro has been under selling pressure for the past few weeks. Can you tell us about the current state of the economy in the Eurozone and how the upcoming inflation data might affect rate hike bets for the ECB and, by extension, the euro's trajectory?
Of course. So the euro has been under selling pressure for several weeks now. Now, some of that is because the dollar has been recovering. Of course, the euro and the dollar are basically opposite sides of the same coin. But there's also an element of economic weakness creeping in. So specifically, what we've seen in Europe lately is a very sharp slowdown in the manufacturing sector, and that has dragged Germany into a technical recession. Now, that's a huge problem for the European Central Bank because economic growth seems to be weakening, but inflationary pressures are still quite hot. So that creates the problem of, do you continue to raise interest rates or do you just wait and see what happens with economic growth? Now, the markets are pricing in another 60 basis points of ECB rate increases over the coming months. That's 2.5 rate increases, give or take. So Whether or not the ECB will truly deliver what the markets have priced in will depend on incoming data. Most importantly, the inflation data we're going to get on Thursday. Now, the forecasts point to a slowdown in inflation, and that's supported by the latest business surveys, which showed companies raising their selling prices at the slowest pace in 2 years in May. Now, if that's the case, and we see inflationary pressures cooling down in Europe, some of those bets for further ECB rate increases could be unwound, and that, I think, is another factor that could keep Eurodollar under pressure.
Marios, thanks so much. And thanks for joining us at XM.com for this Weekly Outlook.